afternoon, everyone. Welcome to another edition of 3 questions, 20 minutes, and one guest. I'm really excited today to be joined by Michael Donofrio. He is the Managing Director of Engineering Tax Services. Michael specializes in national client development, relationship management, and strategic direction. His firm works with preserving wealth, tax mitigation, income generation for over 22 plus years, licensed professional engineers and specialty tax expertise with over 10,000 real estate owners, investors, developers, and projects completed. And the list goes on: cost segregation, bonus depreciation, energy tax credits, tech and solar rooftop leasing, integrative proactive insurance, and capital market strategies. So they wear a lot of hats. We've had the pleasure at Lucerne to work with Michael and his team, more specifically on cost segregation, which will be one of our questions today. Mike, I want to give you a chance to add anything else to what I just shared about you. If
David,
there's
that was a mouthful. I don't know if I could add anything else to that, but it was a really good introduction. Thank you very much.
Yeah, you're very much welcome there. So
Well, I'm coming to you live here today from Charlotte, North Carolina. I understand you guys have some properties around here.
yep, we've had a strong presence in the Charlotte and North Carolina markets for the last 7 years, and we'll continue to invest there as we see growth happening through the Sun Belt area. So
Yeah.
I'm very excited to have you here, and we're going to hit you up with these 3 questions. Once in a while, I divert and ask an extra question, but we're going to go through these questions and hopefully provide some valuable information to the folks that are listening in, whether they're active or passive investors.
Excellent. Yeah,
So go
and
ahead.
just to expand on what you mentioned on the introduction, thank you very much. It's been a pleasure working with you and Frank and the team for a handful of years now on a lot of different properties. Some that you moved forward with, some that you didn't for different reasons. And but you have some amazing properties that I've seen. I mean, I'm a little bit biased about Charlotte and the Carolinas and the Southeast because that's where I live. But we work nationally on all different types of properties. And you're right, our firm ETS, or Engineered Tax Services, we've been in business for 22 years now, so we're not new to this. We're not some virtual, made up AI generated firm. We're a real person. You can come visit me in South Park if you want, or meet us in Palm Beach when it gets cold in the winter. But our firm was focused on being a specialist for real estate, really originally for CPA firms, which is how we met, where CPA firms bring us in as their specialist to help make sure we're not missing anything: federal, state, local incentives, credits, rebates, all of that kind of stuff, really to help extract any additional opportunity out of properties. So that's what we were formed to do, and that's what we do.
Awesome. Well, real estate, a lot of people think of the dollars in, the dollars out, and what's the return look like. But there's a lot more to it. Again, if you're getting special credits that can affect the returns on the deal, we'll get into that. You help with cost segregation and depreciation. Why don't you kick us off and give kind of a basic overview of cost segregation, how it works, and why it's important to use for commercial real estate investors?
Yes, I will do. And most folks have heard about cost segregation either from their CPA firm, or they've heard about it online, or some newer Instagram poster has mentioned it. I mean, it's been around for many years. For over 20 years in the tax code. The IRS allows you to identify and depreciate the assets in a property differently, as long as you follow the rules. And the rules say that, if you take the consolidated approach, and if it's a commercial property that gets depreciated out straight line over 39 years, or a residential property is at 27.5 years, you could take that approach. You could take the straight line depreciation. It's not maximizing the benefits for the property owner, but if you identify all the different parts of that building, inside and outside, the building and the site improvements, the IRS allows you to identify those assets and put them into specific categories or asset classes. The 5-year assets, which is generally the inside of the building, flooring, cabinets, countertops, lighting, electrical, mechanical, plumbing, all the different build out of personal property inside the building. CPAs call that the 1245 assets. And then there's the stuff outside the building and the property that folks don't always think about. The land and site improvements outside. The land's not depreciable, but you have improvements to the land. You have landscaping, you have fences, you have walkways and driveways and loading docks and dumpster pads and all of those things that I'm mentioning. Almost every property has a lot of those things. The IRS allows you to, as long as you're following their rules of identifying all the different pieces parts, much of that will fall into 5-year asset classifications or 15-year, which is the outside the building things, rather than having it all lumped together in 27 and a half or 39-year property. And those shorter term asset classifications, the 5-year and the 15-year, that's what qualifies for bonus depreciation. Everyone has heard about like, oh, there's 100% bonus. And that's true. The Trump era Tax Cuts and Jobs Act in 2016 and then went into effect in 2017 changed the rules so that you could qualify for 100% bonus on those items. Anything under a 20-year classification qualified for 100% bonus. And it wasn't just for new construction or for new renovations or additions. They changed the tax code so it became very powerful for purchases of existing buildings. So if you purchase that property in Charlotte or Dallas or New Jersey or wherever, regardless of the age, the new owner can get the bonus depreciation on those specific assets. And that was a lot of opportunity, a lot of benefit. That's generally 25 to 35 to 40+% of the building cost basis qualified for an immediate write-off. That's what 100% bonus means. But every year now going forward, the bonus depreciation steps down. So 100% bonus ended in 2022. So in 2023, last year, it went to 80%. In 2024, this year, it went to 60%. And then it goes to 40% and 20%. But there is a bill in Congress right now that has passed the House and is on to the Senate. And I hear we're in an election year that may be stalling some things at the moment, but we'll see what happens. I think it has a pretty good chance of passing, and the way it's written right now is boosting it back up to 100% bonus. But again, the election year cycle might be putting some optics on that is slowing things down. But I do think it's going to happen. It's just a matter of time.
Definitely a hot topic and a divided topic for many. Certainly, it helps to promote investment into real estate on the positive side by giving those investors those passive tax losses that they can utilize and encourage, dollars to go into the real estate market. So let's kind of switch gears over to specialty tax credits. I think for a lot of investors that aren't doing heavy development, the tax credits seem like this magical, mythical thing out there in the world. Why don't you tell us about the types of specialty tax credits that are available now that you've been working on at your firm, and where you see things as the future moves forward?
Yes, great question. And specialty tax credits, it gets a lot of attention and interest from clients and investors. And at a high level, they think about things like renewable energy and solar and wind and geothermal and charging stations and these bigger projects, which yes, absolutely qualify for energy tax credits, but not all are actual credits. Some are incentives, some are rebates from the local utilities, some are deductions, depending on what it actually is. But in general, and that's our job as a licensed professional engineering firm and specialty tax firm hybrid, is to look at each property. Is it new construction, or is it a purchase and renovation where maybe you're doing things like putting new lighting, new HVAC systems, new roofs, new windows. I see you shaking your head because I know you guys do all of those things on your properties, and it costs a lot of money to put a new roof on a building right now. But there's specific energy tax credits and incentives for those things. It's not just for the the LEED certified, the extra green buildings, the net zero buildings. If you're doing things that impact the energy efficiency of that building inside and outside, there's energy credits and incentives. One of them is called 179D, capital letter D. Think of that capital letter D as in deduction. That's not technically what it stands for, but that's what I remind folks. That's for commercial buildings, where you've done new lighting, new HVAC, new roof, new windows, or new construction. We'll look to see, because that could be $1.80 per square foot up to, $3-4+ per square foot. And then there's another one called 45L, L as in Larry. That's specifically for residential buildings, that are, 3 stories and less, like some of your properties, either for new construction or for substantial renovations. But you got to get us in the mix early, because there's some specific things that we need to do with, what the specific types of systems that you're putting in, when you're making decisions on certain HVAC systems or installation. There's little things that you can do that makes a big difference. Like 45L, for example, that's a $2,000 credit per unit. Do the math on 50, 100, 250 units times 2,000. That's a lot of money, and that's a tax credit that goes right through to you, to your investors. But those are the examples of the types of things that we look at. Of course, there's the solar, there's the other renewable energy things that we can help maximize on a property. But these renewable energy credits and incentives and the energy efficiency things like 179D and 45L, they've been around for a long time. They've been around since 2006.
Is it a all or nothing proposition? Can you share with everyone? Can you do?
Not always. Good question. 179D, for example, that one could be a scale, depending on what actually the building qualifies for, the level of energy efficiency, the contractor wages that were paid. There's a lot of things that we need to look at that will determine the scale of the benefit, and that's where we can educate really well on the front end. 45L is more an all or nothing type thing. So again, another reason that we need to talk much sooner rather than later when you're developing a property, because we have a lot of folks that contact us every day and they say, hey, I just put this great property into service. It's X millions of dollars that we spent, and we're interested in this 45L credit.
Too late.
And I say, I'm sorry, I wish you would have called me a year and a half ago when you started construction, because the type of insulation that you use doesn't qualify. And they're like, well, what do you mean? But, I don't make the rules. I just tell you what's going on, with the IRS and Department of Energy, and we work to maximize it.
So just to clarify a little further for folks, do you see people using 45L on pre-existing assets that need a lot of updating, and dealing with things like insulation and stuff like that becomes a challenge? Like, what percentage of the business that you see is from pre-existing, if any at all?
Well, it used to be very high in terms of the renovated properties that can qualify, but it's getting increasingly difficult right now because of the changes in the tax law. Some of the energy efficiency requirements and the actual types of insulation, types of HVAC, and other things that they need to use, they've set the bar really high, which is good for the environment and energy efficiency. However, it's becoming increasingly difficult for property owners to qualify or to justify the return on investment for spending extra money for those types of things. So it's getting increasingly difficult, but certain properties, depending on where they're at geographically, the size and the use, you might be doing these types of energy efficiency measures anyways, because of local energy code and building codes. But it all starts with trying to be as proactive with us as possible to make sure you don't miss something easy on the front end.
Yeah, engaging early is very important.
And your team's
Um,
done a great job of that. You know,
yeah.
you and Frank have done amazing.
Yeah, I mean, regardless of, you know, tax engineered services or your attorneys or your lenders, everything is important to engage early on and start the discussion with your professional services and to get the most out of them. So we're on to our last and final question. We got 5 minutes left.
Is this a
I'm going
tough one
to
or is this a softball? Let's go. I want a fastball.
Oh, this is another softball. I'm trying to give the broad strokes so everyone can
All
kind of
right.
understand some of the services and what they are and how they can be helpful to owners. So you briefly touched on it with the solar and the rooftop leasing, 5G, the tech stuff. Talk to me a little bit about um, how much that is of becoming of your business, when, who it's right for and what the
Mhm.
kind of process involved, and does it make sense for an individual operator to look at these additional revenue streams on their properties?
Okay, so the first thing I do is I always look to pick off the low-hanging fruit, when I'm working with a client on a property. And again, I'm thinking just like a property owner, when I'm looking at a building, whether it's multifamily or distribution or warehouse or it doesn't matter, or hotel, it doesn't matter what it is. First, I put on my hat that's like, what's the low-hanging fruit that I need to think about for tax and for cost? So I'm doing those cost seg studies. I'm looking at energy incentives and credits. I'm looking at, property tax, appeals retroactively or something before it goes into building, into service to maximize it. That's the low-hanging fruit. That's the easy stuff. And then, I'll typically put my more entrepreneurial hat on, you know, and say, how do I generate additional revenue on that property, just like a property owner or an investor. It's like, it's great that you're saving me costs. It's great that you're saving me tax, but what can I do to generate additional revenue? So you're looking at, lease income, you're looking at other things, to generate revenue. Is there something on the top of that building, on that roof, on the rooftop, or in the back of the parking lot, or near that retention pond area that is an unused space that either through an energy component, like solar, or maybe covered parking that has solar over the top, so we're getting a credit, plus we're generating some additional revenue, or a technology or security system, that is helping not only as an additional amenity on that property, in terms of a security aspect. So we're monitoring like who's coming and going, do we know who's coming onto this property, but is there a revenue generating aspect to that property? And that's, increasing every single day, because we do the easy stuff, we do the tax and the energy incentives, but then more of a consulting approach. I need to get to know that property, think like a property owner, put that hat on, you know, what's the lay of the land? Where's the extra space that we could do things? And there's a lot of money to be made there, because I know what your rents are. I know what, some of your income streams are, but little things, if we can make, you know, two, three, four, $5,000 a month extra on sections of the roof or sections of an area for, a security or technology application, that dramatically changes your net income and your cap rate, right? And all those fancy buzzwords that you all use in the industry, which is very important. But I want to pay less in tax. I want to cut costs where I can on things that aren't needed, and I want to generate additional revenue either on that rooftop or somewhere else on that property. Or, I think of it like generating additional tenant income on that
Yeah,
property. It's
that's
powerful.
it's powerful. I know this is short and sweet, and we touched on a couple different topics. I really encourage everyone that's investing in real estate as a sponsor or directly for themselves to engage with their professional services, as again, Mike and his team at ETS, they work hand in hand with accountants. They work with our accountant. They're set up to do these specialty services. Mike, can you tell everyone if they wanted to get in touch with you, what the best way to do that is?
Absolutely. I mean, especially if you're in the Carolinas or if you're in Florida, reach out to me directly. But anywhere across the country, my direct phone number is 561-762-0044. 561-762-0044. That's my direct line. You will actually reach me like a real person. Or M Donofrio at engineeredtaxservices.com. That's my email address. The Lucerne team has it. They'll share it with you. I'm sure as part of this webinar, or engineeredtaxservices.com. That's our website. There's some amazing information on our website with videos, that help teach some of these things. And David, you said one of the most important things. Yes, we serve property owners and investors to help make sure we're maximizing their wealth preservation and their tax mitigation. But our biggest clients are also CPA firms, local firms, national firms, as that specialist, because they know a lot of these things that we do, but they may not have the specific expertise or the bandwidth. They're typically looking right now retroactively at last year's tax returns to get those wrapped up. I'm looking right now at this year's and next year's projects with you all, and how we can maximize them. And that's why we worked so well together, not only with the CPAs, but with the owners and operators and developers like Lucerne.
Awesome. Well, I want to thank you very much. I appreciate having you on, getting to see your face and sharing some great knowledge with everyone out there in TV land. Again, if you have any needs for the services that they provide, please don't hesitate to reach out. You could tell Michael's not a bashful guy, and
No,
he's happy to help. So thank you, and until next time.
thanks, David.
All right,
Appreciate you.
thank you. Take care.